we actually had a question submitted about flood insurance and insurable value, which we said, you know what, let's go back and visit this anyway. So I'm going to share my screen here a minute because I've put together a PowerPoint slides for this, and give me a heads up, one of you three, if it's all right. Thank you. So I teach a 1 hour webinar on this, or we teach, and at the end of the 1 hour, you still won't know the answer, is what I always try to joke in the beginning. But there, you need to understand some concepts. So flood insurance has this lesser of three. You have to purchase or require the borrower to purchase flood insurance for the amount of the lesser of these three things. And the tricky one there is, as written in your agenda too, is about this insurable value. It's a difficult thing to come up with. So let me explain a couple of reasons why this is such a big deal. Why is this hard? What is insurable value? And it's like, well, it's the overall value minus the land. And like, well, that didn't really help me. But understand, you're not insuring land. You're insuring the building, and you're trying to help them put it back. And this is the problem. I put this up as a joke, but how the borrower sees their property value, the buyer, the lender, the appraiser, the tax assessor, there's a lot of different numbers out there. And so let's do some terminology first off. If you read in this FAQs, you'll see this about an actual cash value. You'll see replacement cost value. What are those things? Well, replacement cost value is put it back like it was prior to the flood with all new materials though. Actual cash value is a depreciated. In other words, it's replacement cost minus depreciation. And this is a difficult thing, but like brick around my house doesn't depreciate as much as the carpet does, or the shingles. And do I have 100-year shingles versus 20-year shingles and all that? And so the actual cash value is, there's the legal definition of it. It's replacement cost minus physical depreciation. But I think I can do this in plain English. If you wreck your car, the insurance company writes you a check not for a new car. They give you the value of what was remaining in that car before the wreck. That's really actual cash value. Now, most of our policies and the way we try to figure out what is this thing worth lies in those two. But there are other methods you can use. And the big deal is show your work. I mean, it really is. It's about how did you come up with this? Again, I'm going to go, there's an hour long I could do, and we don't have time for that today, but let me hit some highlights. A lot of people look at the appraisal. And I like to say, if you look out my window, that's basically the view you get. I'm in the middle of Nebraska and I can look at a cornfield. I got 20 acres of corn. Pretty cool. Let's say you take my house and you move it to one of my favorite places in this world, and that's Monterey Bay, and you see the Big Sur and all that. What's my house worth there? And the answer, the same. The cost of the materials to put my house back would be the same in Monterey, because Home Depot and Menards and Lowe's charge the same. Now, labor might be more expensive in California, sure, but the what you're insuring is the brick, the shingles, the wood. And so it's really not about location. And that's what a lot of people look at when they look at appraisals. So I'm going to warn you here, there's three approaches on most appraisals. There's that sales comparison, location, the market value. There's the income approach, which most people don't look at. And then there's the cost approach. That's what insurance is about. Finding out, what is this cost? Now, we can look at hazard insurance, but they are an apple to oranges kind of thing. Hazard insurance doesn't pay a full dollar for anything below ground. Because most of the time, what is hazard insurance? It's because there's a tornado or a fire, and the foundations normally are not hurt with those things. We have a cleanup and then we rebuild. When we have a flood, the foundation typically is hurt, and we may have to excavate the whole thing out and start over with foundations and footers or the basements and things. And then flood insurance doesn't cover everything, like retaining walls and driveways and anything in the basement that isn't necessary unless it's to run something upstairs. And it's a whole different product. And that's why it's apple to oranges. But if you said, Dave, you have 30 seconds to teach this, what I would tell everybody is match your flood insurance to your hazard insurance, and you'll probably check the box to meet the regulators' appetite. The problem is that's really not the best approach either. And we saw that after Katrina and Rita hit the New Orleans and Texas and all that back in 2005, I think it was. And they realized that flood insurance is way different. And there were people that had full coverage that really never got paid out. So now that you understand that there's actual cash and replacement costs, and I am doing this very fast, I know, there's other approaches I was telling you, and I'm not even getting into some of them, like the cost approach, the hazard insurance. You also have to understand what kind of property are you insuring, because general property policies only pay out at actual cash value. So you're not really trying to determine the replacement cost. You're saying, what's the depreciated? And there are things like Strunk and Associates that will do, along with maybe some of your systems that pull the credit report, can also get you a value that way. And it's maybe a quick and dirty, but it can get you something. Or you can pay thousands of dollars to get a full depreciated actual cash value valuation. If you're talking about a dwelling, it will pay out at replacement cost value, but there's a ton of ifs. And I'm just going to quickly, it's got to be their primary residence, got to be a single unit, and that's to be fully insured. And that's a whole nother can of worms. What does fully insured mean? So in the end, I like to say it's real simple. Just show your work. And here's the mathematical formula for you. I'm trying to have a little bit of fun, but it is difficult. In short, again, if you're matching up with the hazard insurance, most examiners are probably going to say good to go. There's all sorts of problems that we have when it comes to insurable value. And by the way, we have an article, and Emily, I don't know if you're putting up a link. Thank you. I'll just come out of the share here a minute so that read this article. And let me go there. Are we back to me? Good. That article will summarize, in a sense, some of the high points that I'm making here. But this is a really difficult thing. And again, in the end, even if you have the full hour long, I'm not saying you shouldn't attend that. I'm saying is you never will have, oh, we know the number exactly then. It's still kind of a shot in the dark. And the other problem is you're guessing today how much they need, and you never really go back and adjust it unless there's a Meyer event. You make increase or new extent. Well, when is the flood going to be, and what will cost of lumber be at that time, right? So even if we come up with a number today, it's still not necessarily going to be the right number at the time. And this is just a really, really difficult thing to nail down. Like most regulations, we can say, well, here's the answer. It's boom. You can't necessarily do that with flood insurance. So again, my short part of this would be most examiners are happy with hazard insurance. The problem is there's other risks, like flooding normally doesn't affect one property. It might affect your 2/3 of your portfolio when your town floods. And there's a whole bunch of borrowers then that can't make their payments and things like that. So it's something that we've got to take serious. We got to do the best we can, but show your work and try to come up with what you think is best. The other thing is the agents also have to come up with a value, because they can't insure something for more than it's worth. It's an ethics kind of thing that they have to satisfy. And maybe you get with them and say, how did you underwrite this? What'd you come up with? And that's another helpful thing that I would throw out there is rely on, not always the insurance agents are right. I don't want to say that, but they may be a tool for you. So